Hello guys, welcome back. It's Financial Options with Thumper. And today we're going to be talking about pin risk. And I think this is an important topic that needs to be discussed more because it's one of those Armageddon type events potentially that can wipe you out, take you out of the game. And well, we don't want to see that. This is something I didn't actually learn about until I was many months into my trading career. And it scares me that this is something that could have happened that takes very little effort to completely avoid. At the end of this video, we're going to talk a little bit about margin interest as well. But for the main focus on this is pin risk. So if you just learn one thing from this video, it's that options can be exercised an hour and a half after the market has closed. If you're sitting there on Friday night and your option is near the money and it closes above your strike price, you may be excited. And then if the stock goes underneath it, you may not know that you could be assigned those shares. And if you're not ready for that possibility, you can get hurt pretty bad. So if you learned one thing from this video, it's that options can be exercised an hour and a half after close. The buyer of the contract has to call their broker to inform them to exercise the contract. It won't happen automatically, so there is a chance that even if this happens, you might not get assigned. But plan for the worst and hope for the best is what I like to do. And in this case, I'd rather just avoid the situation altogether. And to drive home a little bit more about what this is about, I came up with a scenario that we're going to walk through. So let's say we got Pete the trader. Pete found $1,000 in an old savings account. He doesn't need this money. He completely forgot it exists. So he decides he's going to, gamble with it, essentially. He's been studying options. He wants to see if he can really make this grow quickly. And he happens to love the stock Thump. Thump stock is trading at $500 a share. So someone to put it on that level requires a lot more than $1,000. Since he knows that spreads require less money because you can limit how much you could lose, he decided that he's going to sell 10 $1 spreads against Thump stock. So in this scenario, he's going to buy 10 puts at $4.99 and simultaneously sell 10 puts at $500. Creating a $1 spread, and we'll just say he collected $50 per contract because it's right at the money. We know the max loss of a $1 spread is $100, and he sold the 500. He bought the $4.99 times 100. There's the $100 loss that he can get per contract. He's selling 10 contracts, so this entire $1,000 can be lost. So the way he sees this, I can make $500 or I lose $1,000. Doesn't matter because it was free money. He watches Thump stock, and Friday near close, Thump stock is trading at 530. Stock market closes, it's above his strike price. He just made 50% on this little gamble. He's all excited. Thump stock had earnings after market. They missed. The stock falls to 400, but Pete doesn't care. He's already out to the bar celebrating. And then Saturday, he wakes up with more than a migraine. He gets a margin call and sees that he owns 1,000 shares of Thump stock that he bought at $500 each. For those of you not good at math, that's $500,000. Assuming that he doesn't have that money, he's now using margin on top of everything else that has just gone terribly wrong with this. And so what happened is, when the stock went under 500, the person who bought the $500 puts called their broker and chose to exercise their option to sell at 500. Pete, being the seller of that, is forced to buy those shares at 500. And since he sold 10 contracts, he just bought 1,000 shares. He was not planning on this because he thought his max loss was 1,000. But since he didn't know he's going to be assigned shares, he didn't know he had to exercise his 4.99s. And also, something to note is, since the stock is now at 400, he's eating a $100,000 loss on top of any margin interest he owes. So what could Pete have done? Well, on Friday, his spreads would have been cheap to close because there was $30 out of the money with not much time left. He might be able to close those for $5 a contract. He could have paid out $50 to secure $450 and avoid this entire situation altogether. To me, this is just kind of the cost of doing business, or you're paying insurance. You would pay house insurance to make sure a disaster doesn't take you out, or renter's insurance, same thing. You're paying insurance to avoid a disaster from happening. Even if it is a low chance, there's still a chance. and you don't want to be taken out of the game because of this. The other thing you might think about is if you continue to watch it, couldn't he exercise his 499s? Well, he could if he has the margin to do that, but at the same time, he doesn't know he's going to be assigned those 500 puts because those are assigned randomly afterwards. He might not know that until Saturday morning, and at that point, his 499 puts have already expired out of the money and are worthless. So this is like the exact scenario that is why people tell you should close your spreads on Friday. The only time I don't close my contracts on Friday is if it's severely out of the money. I have the cash to be assigned, and I don't mind being put the shares, even if there is a dip, and I don't mind holding it over the weekend. If all three of those things aren't there, then I'm closing the contract, even if it costs 5 or up to 10 even to get out of that. Like, it's just a small price to pay to completely avoid this scenario. All right, so let's say that in this scenario, Thump stock only dipped below 500 briefly. It came back up. During that time, the buyer of the contract chose to exercise his contract, and Pete is going to be put all these shares. Well, since it came back up to 500, he got lucky he's not writing a big loss down over the weekend. He's still exposed to any news that happens over the weekend, but in this scenario, we'll just say it stays at 500. On Monday morning, Pete can turn around and sell those shares back to the market at 500, get out without that loss in capital, and he still has that premium he collected when he originally sold the contracts. And the only real loss here is that because he was put those shares, he dipped into margin to secure that. And margin interest occurs daily, overnight holds. From Interactive Brokers, I found this table that has a couple of the most popular brokers and their interest rates. And what happens when you are using margin, it uses like a laddered approach. The first 25K is calculated at 1.59%. The next 250 or 275K would be at this interest rate, and so forth. So there's higher rates if it's just a small amount, and it gets a little cheaper if you have more. But the initial 25K is always at this rate. With that chart, I was able to create this, which shows how much it would cost Pete to hold those shares until Monday morning, so when he could sell it. So the margin interest rate, I'm just using the second row, the second column, because he's using 500K worth of margin. This is the formula I found for how daily interest charge is accumulated. So like this is the per day price. It's calculated principal times interest rate divided by 360. This is what I found when I was doing my research. And, disclaimer, I'm not a financial advisor. These numbers are not guaranteed in any way. Like, do your own due diligence when you start using margin. But going back to here, he has 3 days because he held this over Friday night, Saturday night, and Sunday night. And to control 500K worth of shares through margin, like, really the amount owed for that is not that bad. For a different scenario, if it was just 50K, move the decimal over 1. So to control 50K worth of margin, it only costs you $5 to hold it over the weekend. Like, that's not bad at all. So don't let margin interest weigh heavily on your decisions. But me personally, I take a no assignment strategy, so I don't have to worry about any of this anyway. And closing thoughts. In this scenario, we know it's a hypothetical scenario because Thump stock is only going to the moon. So now's your time to like, subscribe. Okay, that sounded pretty corny, but I'm going to leave that in anyway. Even though this was a hypothetical situation, like, there are real world examples of this, and I don't want you to be the next real world example. If you need to see some videos with real people talking about their stuff, go into YouTube, search options pin risk, and the first couple of results, you'll see, like, this does happen. And for just a couple bucks on the expiration day, you can close it and take this completely off the table. And I think that's going to wrap it up. Thank you, and happy trading. I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please please seek a licensed professional for investment, tax, or legal advice.